Welcome everyone, good afternoon. Welcome to the trading webinar, the Uncensored live Q&A session. My name is Danny and I will give you the webinar today. And we will open the webinar, as I said, with the previous questions with the help of a nice notepad for us to jot the notes, and we will use the interface embedded in our website. This interface, guys, is called a web trader, and you don't have to download or install anything to access it. Just to log in with your email and password, and on the website itself you can select web trading and to be here. This is how the default screen looks like. Of course, we can customize it and make the layout to fit to our needs, which we will do moving forward. So the first thing we will do is just to click here on the arrows to expand the chart all the way up, and then we will click on buy or sell. For the sake of the example, since the question here is referring to a product named AvaProtect, it can only be found on this facility, and you cannot use AvaProtect with MetaTrader 4 or MetaTrader 5. Only on the web trader or on the app, which is called the AvaTrade trading app, which you can find on your phone. Okay, and it's also important to know that AvaProtect is only available for Forex, gold, and silver. So maybe we can have gold as an example. So what we're going to do is we're going to click on the two arrows to expand the chart all the way up. At the top left where it says AUD CAD, we'll click twice and then click on the backspace to erase. And we will put gold instead, and we will select it from the list. And now you can see that the chart has changed. Although it's still written here AUD CAD, and if I'll click buy or sell, this is what will be displayed. Another way to open gold is to simply manually choose it from the categories, and under commodities and under metal, we will select gold. All right, there's something displayed in here. We can clear the drawing. And of course, to demonstrate AvaProtect, we must click buy or sell. Let's go this time with the sell, since gold is relatively bullish. Okay, as we can see here, second candle, we're particularly looking at days. And okay, this is how the product looks like. There is this golden shield, which we can click. This is one way. Another way to activate the product is just to mark the box. And then we immediately see we can choose a certain time here. There is also a number here, okay. And there is expiry, all right. So what does that mean? AvaProtect allows us to protect the position for a certain time frame. Whatever we lost during that coverage will be returned, okay? And there is a fee for using the product. Sorry, when using the product. Why did I correct it? Because even if I click here to enable AvaProtect, but I removed it, okay, again, I activated the product, but I unmarked again, I will not pay a fee, and this position will not be protected. So what does that mean, protected? Exactly as described in here. It will mean, it means that we will get the losses back. And it's important to understand that we will only get the funds back. Let's maybe describe here a certain scenario so it will be easier for us to explain. Okay, let's use the current price. The current price is 3113. We'll jot it down right here. Now price 3113. We can focus on that because gold is going to keep on moving while we, as we explain. Then we will use take profit to simulate the possible profit and stop loss to simulate the possible loss. What I'm doing currently is just to help you understand the product, and it's not mandatory to use take profit, neither take profit or loss or a stop loss with AvaProtect. Okay, just a simple explanation about those two. They are market execution orders like this. You see there is the buy here. This will launch a position right away with the current price. Okay, but I can also automate on the chart pending orders based on the price that I will design. So for instance, if I'll take the current price, we said, okay, and I will extend it by, let's say, 20, like this. And then I will maybe also place here a line to visibly understand where we are. Okay, and this is where the take profit was designed to be. Okay, maybe since we are with a buy, our take profit needs to be in a higher value. When we are buy, our intention is that the value will increase. And then we'll have a stop loss with the same ratio. So we will now subtract 20 from the current price, which brings us to 3,093. So we'll make it like this. Okay. And then we will also fix the load size to 0.01 to just help us demonstrate again, nothing more. We'll paint that in red and also replace to the correct price. Okay. And this will be the levels described on the scenario. Okay, and why am I doing this? Because I would like to make a comparison between the fee that I'm gonna pay, which is displayed in here next to the price, to ensure that the position is not gonna end up triggering take profit and stop loss, which will be lower than the fee. Okay, because let me repeat again what described in the explanation in here. Okay, the purpose is to protect the position, and if we lose during that time that we are covered, okay, at the moment it's 1 hour, but we'll change it in a moment. Okay, so then we will for 1 hour we will pay $8.97. If we choose to extend, we can click here on the plus. We have the expiry right here. If we click on the plus, then the fee will extend as well. Okay, so 3 hours is already $13. What if about 6? Okay, a little more. 1 day, a little more. 2 days, a little more. All right, so in this case, we're about to pay $34.45 to protect the position for 2 days with 1 unit, 0.01. Okay, and if we'll compare the fee to our possible profit or loss, which at the moment stands on $20, okay, we'll simplify that. You guys, you can tell me if this is something that we are looking for. And well, I don't think it's reasonable to pay $34 to get back 20, or to pay $34 to hopefully make 17. Okay, this comparison is to help me use the product more efficiently. If, for instance, I will expand my take profit by another $20, like this, I'll put it a little higher. This is regardless analysis, guys. Regardless analysis, it's only and purely to help you understand how to use the product. Nothing more than that. And if we'll lower that down as well, same ratio, then we will notice, just a second, we will notice that now it's higher than the fee, okay? And if I will choose to extend it as an example to 0.1, we can see that now the fee is lower than the possible profit and possible loss. Keep in mind that I can also reduce the duration. And while I reduce the duration, I reduce the fee that I'm gonna pay. Okay, so back to 1 hour, 89. You remember that it was 8.9, but it was 8.9 with 1 unit, and now we're having 10 units. From that, we can learn the two things affects the fee. One is the size of the position, okay, as we can see here, when it's one lot, so the fee is higher. And the second thing is the length of how much we choose to cover the position. Okay, and I will repeat what I said in the beginning. I will only get the losses that I'm losing during the duration. So for instance, if I choose to keep the position for a week, okay, I'm covered for only 1 day, right? But I choose to keep it for a week. I will only get what I lost during the first day, which is until the expiry, and I may not extend it to another day. Okay, so it's important. This kind of simulation can help you assess how to design a position that makes sense. All right, so this is basically AvaProtect. There is nothing complicated to it, and you don't have to remember the explanation because it's written right here. So if you're using the web trader, you can easily simulate the scenario as I did right here, and you can customize the lot size and see the differences. You can also make comparison to this wonderful product and see if the fee makes sense. All right. So maybe we will take this basic explanation, including that, and we will simply paste it in our presentation. Right. Great. Great. Those 3 points, 3 points, will make it this way. Okay. Yeah, and the second question is, what logic should I use when placing the stop loss? Well, since we've already done something here with gold, and maybe it's important to also point out that we're working with gold at the moment. And the second question is, what logic should I use when placing the stop loss? Okay, great. So the stop loss, what it does, we already know. Okay, from the take profit and the stop loss, we've understood that they are market execution orders like this, that if I'll click on a buy, it launches right away the price displayed in here. And we also have pending orders. So we said take profit and stop loss will be triggered automatically when reaching the price. It's quite self-explanatory. Take profit will close it and take the profit. Stop loss will close it and stop us from losing more. What does that mean, execute when price hits? Well, we can as well automate the entry and choose a price in advance, that if we don't want to launch the position at market execution, what we can do is we'll go with a pending order for a buy. How does this became a pending buy? Because this order acknowledges what is selected. What is selected on the chart. So if, for instance, I'll click here on a sell, this will become a pending sell. And if this is a buy, then this is a pending buy. Okay, and as I have explained, with a buy, take profit needs to be in a higher value. Okay. All right. There we go. Oh, just a second. All right. Now we are great. Okay. So with what logic should we what logic should we use? Well, the first thing that I would like to do is to first think about what kind of ratio I'm looking for. That means if, for instance, I'm looking at the ratio that we have, we potentially make or lose to 40, great. So this is a one-on-one, one-to-one ratio. The second logic that I'm gonna look for is, of course, to compare that with my balance to ensure that the loss I can possibly have will not devastate my account, and I still have the margin to maintain the rest of my strategy. So for instance, if we choose to extend and we will go with maybe 0.5, we can now see that the possible profit and loss was increased to 2,000. And how does that work? Well, we can see that since we have 50 units, okay, 0.5, we have 50 ounces since we're trading gold, multiplied by a price difference of 40. How 40? Well, because we bound the entry to 31.13, and the take profit is designed to be activated at 31.53, which is $40 away. Yeah, this is the price difference. Same apply with the stop loss, just downward and not upward, since we are with a buy. Which brings us to 2,000 versus the 10,000 we have in balance. Okay, so we've got balance of 10,000 we said, and we have take profit and stop loss and entry, which will be that, and this will be that, and this will be that. Okay, and that leads us to 2,000. What is 2,000 out of 10,000? Well, casually that will be 20%, but we'll also work out with an equation that will help us precisely know a number that is not so casual, maybe a different number. We'll see in a moment. Okay, so the equation is very simple. It will be potential loss divided by balance equals factor. Then we've got factor times 100 equals percentage exposure. All right, so if we'll take 2,000 divided by 10,000, that will be 0.2 times 100 equals 20. Yeah. Okay, we'll do it together. Okay, again, we'll take 2,000 divided by 10,000, that's 0.2, that's the factor. Oh, sorry, times 100. Okay, 20%. Now, if for instance, I would like, as an example, 2,000 is way too much. Let's suppose that I want this 2,000 to be, I don't want to take 200 because it's too casual number, and I would like to show you the differences. So maybe we'll go for something like 1.5%, maybe 1.2% is an example. Okay, so how can we make this 20% to 1.2? Who has an idea? Well, logically, since we're looking at $40 away, okay, and we are with 50, it leads us to 2,000. From that, we understand, okay, that the amount of units we've got times the price difference gives us the possible loss or profit, which is similar to the calculation that the platform does here. Now, 1.2% is 120 with the same equation we've got here, right? 120 out of 10,000. Okay, so how do I make this 2,000 to 120? That means that now I need the stop loss to be only $3 away from the entry. So that means it needs to be that. Okay, maybe a bit less than that. Oh, sorry, the other way around. Okay. However, I would like to tell you guys right away that the stop loss can't be too close to the entry. It can't be too close to the entry. Who can tell me why? If I place it like this, It's only $3 away. Who can tell me why it can't be? Okay, because we understand that the market fluctuates both sides, and we can see if we'll switch from days to, let's say, hours, okay, that it takes less than an hour, and gold can possibly trigger our stop loss. Okay, so another key factor that we can use is also support and resistance. We'll get to it in a moment. But right now, we're just focusing on the comparison to know our exposure. Okay, because 2000 is 20%, and as we have understood, 20% is quite represent the large percentage of the account. Okay, although I'm not saying if it's good or not. But it's much more than what we see now. So maybe if we don't want it to be too close, we want something in the middle. We don't want it to be $3 away, but we also don't want it to be $40 away. Okay, another thing that we can do is, of course, to lower the lot size. We can lower the lot size. It's true that it will also impact the possible profit, but this way we have more flexibility to take the stop loss farther away and still get the same exposure that we want. Okay, so let's see how we can do this. Maybe if we will reduce it by, let's divide it by, maybe we'll divide it by half. Okay, and now we see that the stop loss has gone farther. Okay, it's gone farther like this. And we can see 1,000 in possible profit and 125, which is the same percentage, but few dollars away. So in other words, the more I want the stop loss to be, the farther away I want the stop loss to be, okay, from my entry, and maintain this possible loss, I can reduce the lot size. Keep in mind again that this will directly impact your possible profit. So if you reduce it too much, like this, as an example, we reduced it by to 10%, yeah, and our stop loss and our take profit will go back to the original price, and the stop loss will be at the original price. Okay, we see that now both of them are very, very low compared to what we had in the beginning. We had 2,000, it was a reasonable amount, it seems good and all right, but compared to our balance, it might be a bit too much. So what we did is we reduced the lot size, but now it seems a bit too extreme. Seems a bit too extreme. So if I'll choose something in the middle, maybe around the $10 away, it seems right. Okay, $10 away for the stop loss. So this will be, okay, this will be 2.5% from my balance. Okay, and you can see that the possible profit here is 1,000. So if we compare the new numbers for the profit and the loss, we are now looking at a ratio of 1 to 4. Okay, and we're no longer in exposure of 20%, but we are in exposure of 2.5. How can I validate this? With the same equation in here, 250 times 10,000 equals 0.025 times 100. Okay, and all right. Okay, so you can see how easy that is. Okay, just even I'm using a calculator, nothing special here. All right, and we have customized it like this, and that's wonderful. Another logic that we can use is, of course, to apply an indicator that will allow us to assess the potential movement, the average movement. I guess you're familiar if you watched the previous webinars with ATR, and with ATR, average true range, we can click and drag it to the right, and we can select how many candles we want the ATR to analyze and give us an average. So if at the moment it's 14, it will be the length here is based on the reference displayed on the chart. So for instance, if I'll click here on 14, I'll click save, it's going to show me 15. Oh, okay, we're looking at hours. We're looking at hours. It's 15 per hour. You see what I meant by if it's too close. Remember, if it's moving 15 per hour and our stop loss, when we pushed it up, it was $3 away to make it to, never mind, it was to get to 220. Okay, so you can swiftly get there. Now, if we focus on 1 day, okay, if we focus on 1 day, in terms of the profit, if we compare it, just a moment, guys, just a moment. If we compare it with the take profit, how far away is the take profit? $40. What is the average movement for gold per day? $50. So it's reasonable that it will get to that level on average in a day. It might be more, it might be less, it might even turn around, but this is the average based on the past 14 candles. Based on the past 14 candles, which can easily select, can be selected from here. ATR is one of the accelerator indicators, and you can design to whatever length it makes sense to you. Maybe if you don't want to go 14 days back because something fundamental happened 5 days ago, and you know that the previous 9 days they're not included because the market is acting different only in the past 5 days. So what I can do is I can go 5 and I can click save, and then I can see that the past few days it wasn't moving 50 per day. Okay, it was moving 70 per day, okay, on average. This is based on the past 5, okay? So we've got another 20%, maybe more, maybe 40%, okay, because we have limited to fewer days. Okay, now, so those are the main factors, those are the main keys which we can rely on when we are placing the stop loss. Of course, there are many more, and I'm sure there are more advanced formulas to help you assess the stop loss, but those basics ones seems to do the job, at least for me. All right, now with this comparison, we're gonna take everything as it is. We're gonna take it like that, and we will, oh, one more thing that I wanted to do, which is the purpose of this question. Compare it also not just with the take profit, but also with the stop loss. Okay, and we can see that since the stop loss is designed to be $10 away, I have no doubt in my mind is a possible scenario it will be triggered within a day. Okay, again, if I'm with the buy, my intention is that the value will increase, but I've selected that level because this seems to be a new support line. The other support, this next support line is much farther down, and of course, if I'll base my stop loss on the next support line, it will be very far away, which will not allow me to maintain the percentage that I compared with my balance. It's a bit complicated, but like I said, if there is any, you can watch the recording again in your own time and recap whatever parts you need. Okay, and we will simply, oh, something has happened here. Okay, just a second, no need to panic. Okay, maybe we'll make it smaller. This way I know that it's a little messy altogether like this, but at least it's all connected. So again, you can watch the webinar. And all right, the next question is, how much margin should I use per position? Of course, there is no definitive answer for that because it depends on the strategy that I'm using. Also, the margin that I would like to keep available is meant to do a couple of things. One thing is, of course, to open additional positions. Usually, well, I shouldn't say usually, but I can just say it's very common that I would like to diversify and not trade a single asset instrument in my strategy. Sometimes I want to take a position with gold, and I want to take a position with Nasdaq, and I want to take a position with Tesla, and maybe Nvidia, and some other things as well, right? Maybe Dow Jones, okay, and so on and so on. So I need to calculate I need to think about the margin that I'm taking per position based on how many positions I'm taking and based on the size of the position. Why? Because the margin is because the margin is determined. The margin that I'm going to use is determined by the size of the position and the amount of units that I've got. So, and which is measured by lot. Okay, lot is a measuring unit. If you would like to know how much contracts in one lot for an instrument, you can just erase whatever is here and type 1. Another nice way to do it is to click on instrument details. And in instrument details, it says here lot size 100. Okay, what does that mean? It means that with 1, we've got 100. With 0.1, we've got 10. And with 0.01, we have 1. What if this would have been another instrument with a different lot size? Well, let's take silver. And with silver, we'll click on buy. And with silver, we'll also place here 1 lot. And then we see that with 1 lot, we have 10,000 units. What does that mean? It means that with silver, with 1 lot, every dollar on the chart will benefit, okay, will benefit $10,000. Okay, if we'll bound it to like this to an entry, and we'll also be precise with the decimal. Oh, something jumped. Sorry. There we go. Oh, not even that. There we go. All right. So since we have used again the execute when price hits for a pending buy, we get the flat price. And with this flat price, we can see since this is $1 difference, we can make or lose 10,000. If this would have been 0.1, so it's 1,000 units, and 0.01, 100 units. Okay, great. So we have different lot size and different types of lot size. Typically, currencies will have a big lot size. So if we'll take USD CAD as an example, and we see that the lot size for a currency pair is 100,000, okay, and you can understand from that the smaller the value of an instrument, the bigger the lot size. Okay, for instance, let's take. Okay, I'll explain to you in a moment why does this make any difference. Okay, so for 40,000 we've got 10. We'll understand in a moment why does this make any difference. Because if, for instance, I want to take a position with something other than gold, and now I'll take 100, and now I'll take 1 lot, okay, and I want to know the margin that will be used on this position. Let's get rid of all of that. Okay, maybe we'll put it aside because it will be useful in a moment. Okay. And let's stay with one lot. I think one lot does make sense. And with one lot, we actually have 1,000 barrels, not like with gold. With gold, one is 100, right? This time we've got 1,000. Why does this make any difference? Because if we look at the price per unit, which per barrel, this is barrels, trading oils and barrels. The price per unit is 60, so 60 per barrel, okay, for a buy. And we are looking at the numbers of barrels, which will be 1,000. So number of units, let's keep it in units, is 1,000, yeah, for one lot. And we will multiply price per unit times units equals value, which displayed in here. And then we can go and divide the value by leverage. Okay, so the leverage here is 1 to 10, and what it does is it multiplies buying and selling. Okay, and now we know that we are multiplied by 10 for crude oil. Since we're multiplied by 10, we can divide the value by the leverage to know the necessary margin. We call it the margin impact. So we can go value divided by leverage equals margin impact, which in this case is 60,000 for 90 divided by 10 gives us okay, yeah. Now, if we compare it with our balance, again, balance on this account is 10,000, right? So if we compare it with the balance, how much margin are we using? More than 60%. More than 60%. Okay? Will this allow me to trade also all of those? Okay, let's take another one. Just of course, we'll add it to the list. Let's take another instrument just as an example. Maybe we'll use NASDAQ. Okay, and with NASDAQ, we'll go for 0.1. Oh, we gotta click on the, change that to NASDAQ. Oh, we have to close that first. And now, and with NASDAQ, we'll go with 0.1. Well, we can't even do that. There we go. Okay, so if we not even that, okay, now we're really on the edge, but that will help us to precisely convey the message here. Okay. Now we've got two positions. This was with oil, one lot crude oil. Now we've got 0.04 NASDAQ. Okay, so how much margin are we using now? All right. Yeah. Well, I can reduce this 0.04 and have maybe another position with the rest of those. But the point here is to show you guys how to balance. And when you choose how much margin you would like to use in every position, I think a good idea will be to think how many positions you're taking, what size of positions you typically take in, and making this general comparison to allow you to also maneuver. Because when the market go against you, You need the margin level to be in a stable level that allows you to maintain the necessary margin. And if you don't, the platform will have to close the position if you cannot fulfill the margin requirement. What will happen is when your margin level drops below the requirement, is that the platform will close the first position, the biggest position first. Will close the biggest position to free up the margin. Okay, so keep in mind the margin is something we would like to maintain at all times at the proper level, and to utilize properly when opening and trading a position. How much margin are we using and how much margin is left available? All right. Of course, naturally, the more profits I'll make, the more margin I'll have. The more losses I have, the less margin I have. It's self-explanatory, but I guess it's something that should be said. All right, we'll take all of that. And again, I really doubt that this will fit into the presentation, but who knows? Let's try and be optimistic as we can. This needs to be minus, right? Somehow, and then, oop. Yeah. Okay, this way I keep it in a row. This is why I don't wanna. Okay. Right, and this formula, of course, is not only for crude oil; it's for everything else as well. So you can use it as you want. We will also reduce, of course, the size of the font. Still, as I said, I was optimistic, and I thought that it will. Oh, actually, it does. I'm very surprised. No, okay, almost. We were close. The last question we've got is trading once a week enough to make money? Well, of course, there is a whole strategy based on that, which is called weekly trading, right? Weekly trading. As I said many times, the time that we're spending on the chart, if we're trading once a week or twice a week or 5 times a week, is not what determines if we will make money or not. What will determine if we will make money or not is the market. Okay, we've got no control on what the market will do. However, we can choose what level of analysis we will perform. If we, for instance, look at this, such a nice reversal we've got in here. Okay, there are levels of analysis that we can choose to do. If, for instance, we're only based on this green candle, we'll say we can even go more basic than that and say, okay, this candle here is red. I think that oil is going down, so I'll take a sell without doing any analysis. Just looking at the red here, okay, it goes down, I'll take a sell. I can enhance this analysis and say, listen, this candle is not just by itself, it's a part of a structure. So I think before that it was green, so maybe I'll take a buy. And then I can see before that it was bearish, so now it's back to a sell. Well, there are structures that we can identify. As an example, we can see that this is another bull that is part of a structure here. This candle is a reversed hammer. That means that it pulled up, went back, and it closed on a lower level than the high that it got into, okay, which was 63.96. Okay, we can enable the crosshair. This way we get also the numbers from the candle. As you can see, the high here is 6389. Okay, so we can flatten that out. 89 we said. 6389. Okay, and with this we can say, okay, so initially we begin with only looking at the red here and saying this might go down. Okay, then we discovered that it's part of a structure. Then we discovered this guy, and we've understand that there was a pullback, and we saw that there is a reversed hammer here that shows us that the potential trend here was recovery, and then it's followed by a bear, and then this bull has extended crude oil almost all the way back to the resistance, which was 63.89, and it pulled back today. So we understand that this wasn't just maybe I should put a line here, just a trend line. There we go. This is not that. Okay, this is not just one line. We understand that there were fluctuations here. There were down, up. Okay, this also considered an up movement. And then it went down, it went up again, and it went down again. So there is a whole movement here. And we can also add indicators to help us assess that. And on top of everything we've done in here, we can also go into the news section. And in the news section, under commodities, we can search for something related to oil, maybe even the pre-use market brief or the inventories, which on Wednesday, right? And we can enhance our analysis on top of what we've done on the chart with the reason of what happened and what caused oil to plunge like this. Oh, we are still displayed. We'll select it from the list, and maybe now. Okay, great. Okay, so the time is not really what determines if we will make money or not. Is how we use the time. If I'll go to the gym and I'll sit there and play with my phone or whatever else people do these days, I'm not gonna get in shape, even though I've been there a few good hours, right? So on the chart, if I'm looking at the chart and I'm doing analysis and I'm using the tools in this facility, there are many tools. I'm also going to share with you a few links to help you get to the academy and see tutorials. And I'm also going to show you a nice way how to do it from right here. And then you can make the time efficient. And when you're trading this once a week or twice a week, whatever time you've got, you make it efficient and you do it properly. Okay, so naturally, and we've got the signals as well. This is something we've added recently. We've got here signals. If we're not so strong with support and resistance and we would like to use signals, it's another way. We cannot control the market, but we choose what level of analysis we will do. Okay, so in this case, that's what I think. So once a week, all right. The time spent on the chart does not affect how much money we can make. And as I've explained, I don't want to write it down because it's like I said, that the level of analysis is my own interpretation to what I showed you here. Of course, you can take it even further, and you can learn different specific strategy using Fibonacci and stochastics and all kind of useful things, and RSI and Bollinger. And look what a nice list of indicator we've got here. Okay, all kind of things. We're not going to speak about all of them today, but it was important for me that you guys will know you choose how optimized you want your analysis to be. Okay, and that also requires time, I agree, But even if you do it specifically and with the right procedure and with the right guidance, you can have excellent results, even once a week. Okay, so the time spent on the chart does not affect. Okay, and yeah, I think this will suffice. Putting time into analysis and better design of position can lead to better results. I'm not going to say that if somebody does a lot of analysis, he can make money or not, because there are also other things like risk money management and the efficiency of the strategy, which instruments you're using, and how many positions you're taking. We'll speak about it all the time. So, okay. All right, great. Now the last slide in here is to share with you some links here. This can lead you to even more education, okay, and help you with analysis and better understanding about trading. The second link here for logging and make it deposit, if you're still with the demo and you want to get down to business, as they say. And then we've got here the FAQ and the Help Center. The account is a similar idea to evolve from the demo. And lastly, the Academy, which I'm going to show you now. A very nice shortcut to get to the Academy without even leaving the website. Okay, you will be leaving the website, but you will be leaving it like this, in just a click on a button. You see in here, if you point in here, you've got education, you've got tutorials and Academy, and Academy takes you to the Academy. And at the top, you've got tutorials. And as I have explained, in tutorials, you can find a lot of useful materials. You've got trading basics, you've got all kind of useful things here, really. All kind of useful things. There is another webinar which I'm going through the facility and explaining a bit more into depths what other features we've got here that can be useful. But in here, you can enjoy a variety of tutorials that can help you get better reading the chart and so on. Okay, so unfortunately, guys, the time is run up for today. I hope you learned at least one thing from this webinar. Until next time, I wish you all fruitful week. Best of luck with trading and have a good day.